What's up, everyone? Welcome back to Kysersis, where we break down money, mindset, and mastery without the fluff. And today we're diving deep into one of the most misunderstood money machines out there, the stock market. You've probably heard things like buy low, sell high, the market crashed, or invest in your future. But what does any of that actually mean? How does the stock market really work? And more importantly, how can you use it to build wealth instead of just watching others do it? Let's start simple. At its core, the stock market is a place where people buy and sell pieces of ownership in companies. These pieces are called stocks or shares. Imagine you start a pizza shop. It's doing great, but you want to expand. You need money to open a second location. You could take out a loan, or you could sell part of your business to investors. That's exactly what big companies do when they go public. They sell slices of their company, shares, to investors through the stock market in exchange for capital. When you buy a share of a company like Apple or Amazon, you're literally buying a tiny piece of that company. If it grows and makes more money, your piece becomes more valuable. If it struggles, the value drops. Simple enough, right? Now let's get into the meat. There are two main stock markets in the US, the New York Stock Exchange, NYSE, and the NASDAQ. Think of these like giant marketplaces where companies list their stocks, and buyers and sellers come together to trade them. These trades happen through brokers. Companies like Fidelity, Charles Schwab, Robinhood, or E-Trade. You can't just walk up to Wall Street and say, "Hey, give me 2 Teslas and a side of Google." You need a brokerage account, but once you have that, you're in the game. Now here's a big question people ask. Why do stock prices change? Great question. Stock prices change because of supply and demand. If more people want to buy a stock than sell it, the price goes up. If more want to sell than buy, the price goes down. But the real driver of that supply and demand? Emotion, speculation, and expectation. Let me explain. If a company reports higher earnings than expected, investors get excited. They think the company's future looks bright, so they start buying, which drives the price up. But if the company has a bad quarter or there's fear in the economy, people might panic and sell, dropping the price. So while stock prices should reflect a company's value, they often reflect people's feelings about its future. That's why the market can be irrational. Here's where things get fun and risky. There are 2 ways to make money in the stock market: capital appreciation and dividends. Capital appreciation is when the value of your stock goes up and you sell it for a profit. Say you buy a share for $100 and later it's worth $150. You sell it and boom, you made $50. That's capital appreciation. Dividends are when companies pay you a portion of their profits just for owning their stock. Not all companies do this, but many big, stable ones do. Think Coca-Cola, Johnson & Johnson, or Procter & Gamble. You're basically getting paid to hold the stock. Now let's talk about investing versus trading. Investing is the long-term game. You buy stocks with the intention of holding them for years, maybe decades, because you believe the company will grow. This is the Warren Buffett strategy. It's slow, steady, and proven to work over time. Trading, on the other hand, is short-term. Day trading, swing trading, options. It's all about timing the market, getting in and out fast, and trying to profit from the volatility. It can make you money quickly, but it's risky. Most people lose money trading because they're playing a game they don't fully understand. And speaking of understanding, let's clear something up. The stock market is not the economy. They're related, but they're not the same. The economy is how much we're producing, consuming, earning, and spending as a country. The stock market is a forward-looking machine that reacts to what it thinks will happen. That's why sometimes the market goes up even when things feel bad on the ground, and why it can crash even when things look fine. It's a confidence game. Now you might be thinking, okay, cool, but how do I start? Simple. First, open a brokerage account. There are tons out there, and many have 0 fees to get started. Look for one that's easy to use and has good tools for beginners. Second, educate yourself before you invest a single dollar. Learn about different types of investments. Stocks are just one piece of the puzzle. There are ETFs, mutual funds, bonds, and more. Let's talk about ETFs real quick. Exchange-traded funds. Think of them like a basket of stocks. Instead of buying one company, you're buying a collection. So if one goes down but the rest go up, you're still solid. It's a great way to reduce risk. One of the most famous ETFs is the S&P 500 ETF. It tracks the performance of the top 500 companies in the US. If you don't want to pick individual stocks, just buy the market. That one move has made regular people millionaires over time. And here's the kicker. You don't need to be rich to invest. You can start with $10. Seriously. It's not about the amount, it's about consistency and time. The earlier you start, the more compound interest works in your favor. That's why the saying goes, time in the market beats timing the market. Let's also address fear, because a lot of people avoid the stock market because they're afraid. They hear about crashes, scams, volatility, and yeah, those things are real. But so is inflation, and that silently eats your savings if you do nothing. Investing is about managing risk, not avoiding it entirely. That's why you diversify. That's why you learn. That's why you don't bet the farm on meme stocks or random tips on Reddit. You treat it like a craft. You respect the process. You play the long game. One of the smartest ways to approach investing? Dollar cost averaging. That's just a fancy way of saying you invest a fixed amount of money at regular intervals, like $100 every month, regardless of what the market is doing. Sometimes you'll buy high, sometimes low, but over time, you even things out. It removes emotion, builds discipline, and works better than trying to time the market. Another tool to know about, 401ks and IRAs. These are tax-advantaged retirement accounts. If your job offers a 401k, and especially if they match contributions, use it. That's free money. If not, look into a Roth IRA. You invest with after-tax dollars, but your money grows tax-free, and you can withdraw it tax-free in retirement. That's powerful. So how do you build a winning portfolio? It depends on your age, your goals, and your risk tolerance. But a simple rule of thumb is this. If you're young, lean more into stocks. You've got time to ride out the bumps. As you get older, shift more into bonds and stable assets to preserve your capital. But no matter your age, the most important thing is to start. Not tomorrow. Not when the market is perfect. Now. Because when you invest, you're not just buying stocks. You're buying ownership. You're planting seeds. And with patience, consistency, and knowledge, you're building a future that works for you. Let's do a quick recap. The stock market is a marketplace where companies raise money and investors buy shares. You can make money through growth or dividends. You invest for the long term. Trade only if you really know what you're doing. And always keep learning. Start small. Stay consistent. Diversify. Use tax-advantaged accounts. And remember, it's not about getting rich quick. It's about getting rich eventually, with intention. That's how the stock market really works. If you found this helpful, hit that like button, subscribe for more no-fluff breakdowns, and drop a comment. Are you already investing or just getting started? Let's talk about it. This is Kysersis. Stay sharp, stay sovereign, and stack wisely.